Our next guest is someone you will know, of great rapport, lively and energetic. He's going to kick us actively into action. I have no doubts. And in fact, if I say guest number two, you'll probably have an idea of who it is. Yeah, he's known for moving around in fast cars, big trucks, and he manages to explain the difficult to explain rather well. His name is George Gammon, previous star on our show, very, very popular. And he's gone about properly breaking down how this whole system and Ponzi has been running. And he will have seen an immense amount that's gone down in this year that I think he'd like to carry with him as wisdoms. And I'm sure he's pretty much on the other side of here, waiting to come on. So, George, let me know. Are you out there?
Yeah.
Oh, great. There he is. Great. Great to have you. George, looks like much the same last time we spoke. Are you Arizona stateside?
Yeah. I'm just in Phoenix for a couple months here.
Excellent. Welcome. Well, first of all, what a year we've had. We are putting it to bed, the burying of 2020. I don't know how you feel about it. If I give you an opportunity, just before, I suppose I should give you an opportunity to introduce yourself as best as you can. And also, we're going to open a virtual bubbly with you. I'm afraid you won't be able to have some of the champagne, but I'm hoping that there's some nearby. But thank you for being an awesome guest last time. We're looking forward to hear what you hear and wishing you all the best for Christmas and the new year. We've been a bit frivolous. We're trying to look at the bright side of life. If you remember the Monty Python skit, as we head into 2021. So while many supposedly pretty negative things have happened, we are burying 2020. We've also gained a bunch of knowledge. What's your big takeouts for 2020? What have you most learned about the financial system, and what knowledge would you suggest we start by applying strongest going into 2021?
Well, I think you're seeing in real time the extent to which governments are willing to extend their power. And I think that's all, on one side, obviously it's frightening. On the other side, at least they're showing their cards, and you can say, okay, well, here's the line in the sand. I would argue there probably is no line, but that in and of itself is knowledge.
Yes.
And that knowledge is power. So if you now know that there really is no line that they are unwilling to cross, you can start setting up your life in a way that hopefully will have the highest probability of maintaining your personal freedom and liberty. So I think you could say, well, that's a bad thing. It's on the other hand, I think it's a good thing. It gives you that knowledge and power that we were referring to. As far as just broad strokes with the markets, I think it's very apparent that we're getting MMT. You had Janet Yellen come in as the Treasury Secretary, and the first step to MMT is just combining the balance sheets of the Federal Reserve and the Treasury. So if I was going to do that, who would I hire as the Treasury Secretary? Just someone who was maybe the last Fed chair. It's a pretty good idea of how both balance sheets work. So I think
even the actors are being combined, aren't they? The same actors are coming into scene.
Yeah, I think I tweeted out the other day, I was just kind of joking that now they're going to hire Stephanie Kelton after Jerome Powell leaves, and that would just be the icing on the cake. But I think they're going in that direction anyway. And I don't know that that's really a tinfoil hattish type of view. I just spoke with Danielle DiMartino Booth yesterday, Friday, and she has the exact same opinion that that could potentially be why they're bringing in Janet Yellen. But even if it isn't, that's going to be the direction they're headed now. And so that just means the Federal Reserve taking bank reserves, which is really the only thing they can print right now, and turning them into legal tender by spending them directly into the economy without going through the banking system, the commercial banking system. And now they're kind of getting around that through the government spending it, the Fed monetizing it. But they might even just kind of cut out the charade. I think that's another thing in 2020 that we learned is that we've really become a nation of men and not of law. Because you look at what we did with the Federal Reserve Act, meaning we completely ignored it in March of 2020. And I don't think that if even pundits on CNBC, I don't think they would even argue that the Fed stayed within the confines of the Federal Reserve Act back in March. I think everyone would admit that, yeah, they ignored it, they got around it, and the special purpose vehicles set up just to buy junk debt, that's just smoke and mirrors. But no one called them out on it. And they're like, well, yeah, it wasn't part of the Federal Reserve Act, but they had to do it. They had to do it. And I think, again, this shows us that the economy, and also shows us that they know this, they realize this. The economy is built on asset bubbles, debt, and confidence. Yeah. And they realize if they don't prop up the asset bubbles in particular, that the economy will collapse. It'll crash down on itself, in on itself like a house of cards. So we see that what they're willing to do, which is pretty much everything, QE infinity and all these 4 and 5 letter programs, and taking the Fed's balance sheet up over, I think it's 7.3 trillion. I was just listening to my good buddy Peter Schiff the other day, and he was saying that just last week, the Fed's balance sheet went up by over like 120 billion in just the 1 week. He was saying that he thinks the Fed's balance sheet could go to 10 trillion by the end of 2021. And I think we could get there earlier than that, just depending if we have on whether or not we have another crisis. I think that as long as the stock market is kind of elevated, the central planners at the Fed or the government are less incentivized to go in and just throw everything up against the wall to see what sticks, taking the Fed's balance sheet, that 10 trillion. But if we get the market coming down violently, like it did in March, I call it 20-30%, that's when you're going to see the balance sheet go from 7 to 10 trillion very, very quickly, in my opinion. So the Fed and the government, I think, really showed us their cards with what they did back in March. And I think, again, that's a good thing if you're a long-term investor. It shows you that they're more than willing to trash the dollar. I don't know that, I'm very sympathetic to my good buddies, Jeff Snyder and Brent Johnson, who are more in the dollar bull camp. And I don't think by any stretch it's impossible for the dollar to go back up to, call it 110 or 120. But I don't know that the central planners are sophisticated enough to even understand Brent and Jeff's argument. I think that they're just, trying to get the dollar weaker to kind of offload some of the burden of the debt that the government has assumed in 2020. Most people don't realize it, but they'll probably tack on about 5 trillion in debt, which is the same amount of debt the whole entire country accumulated from 1776 to 1996. So 220 years, that's a lot of debt. But my point is, I think they've shown their cards that they're willing to just try to create as many currency units. And even if under the current system, that's difficult for them to do, therefore the debt would be deflationary. I think in this new system of Janet Yellen coming in, combining the balance sheets and them spending bank reserves as though they were actual dollars in legal tender, that's the next step. And we know, and even Jeff and Brent, I think, would admit that if they start doing that, they're going to reevaluate their deflationary and dollar bullish stance. So once they kind of cross that Rubicon, which I think they will, we know that they have no problem whatsoever printing as much money, and that would be literal money printing, enough to take the dollar down, to 70, maybe 60, maybe even 50. Wow. So the great thing is we know that, so then we can position ourselves accordingly, but then also go through the thought experiment, which is what I've been doing this weekend, on figuring out, okay, so the dollar right now is called 90, dipped down 89 handle. So if it goes back down to 70, a lot of people think, oh my gosh, that would be catastrophic. But you got to remember that just going back to, I believe it was 2011, we were down at 70 on the DXY. So I don't think it's a matter of the catastrophe being if it goes back down to 70, but maybe more so how fast it goes to 70 and how violent the move is. But then you think, okay, well, 50, 60. What does that world look like? What does that do to U.S. exports? What does that do to imports? I think a lot of people that want to put on their rose-colored glasses would say that, oh, well, that's great news because then the U.S. exports will be far more competitive and we need to manufacture more things here anyway. But you don't realize that we've been running massive trade deficits for a long, long time, meaning that we import a lot more than we export. So I think the impact of the prices that at Walmart and Target and Home Depot, all those things that we import, going up significantly would more than outweigh the benefit of maybe some manufacturing. And then also that assumes that the regulation or the regulatory environment in the United States is conducive to creating more manufacturing. And I would argue that it's going the complete opposite direction. So many people, so many economists, they look at just the currency going up or down and say, oh, that's going to be good for manufacturing or bad. But they never seem to consider the regulatory environment. And I think I've got a little bit of an edge there because I was an entrepreneur my entire life. And I didn't know the first thing about macro or economics. I didn't know what a yield curve was. I didn't know what the Fed was. But I knew how to start a business, and I knew what the differences in starting a business in a place like California, which I did, and how much different that was in starting a business in, let's say, Arizona from a standpoint of regulation.
Yeah.
And I know how difficult it is to operate a business. And keep in mind, this was all the way back in maybe 2004, 2005 was the last time I operated a business in California. So I can't even fathom what it's like now and how restrictive it is. But I think that a lot of the macro thinkers, obviously these guys and gals are incredibly intelligent, far more intelligent than I'll ever be. But they don't really ever consider the regulatory environment for their inflation, deflation type of projections. And I think that could be a mistake. So my point is, from a regulatory standpoint, I don't think manufacturing will ever come back to the United States in a significant manner, because who wants to take that $1 billion worth of capital and put it to work in a jurisdiction that most likely is going to be very unfriendly to business in the next 5-10 years. I think, again, I don't want to be too doom and gloom. There's a lot of things that are frightening from an economic standpoint, personal liberty. But I think the good news is we're seeing what they're willing to do, and therefore we can be more prepared. We won't be blindsided by it in 2021 or 22.
Yeah. I love your opening statement, by the way. That's a great opening statement. We covered actually a lot in that. One of the things I most like is that we've got great guests. Many of them, you've just mentioned some of them coming on after you. But of all of them, I'd say you probably represent where you recognize that there's a greater game going on a little bit more, you're more prepared to speak about it. I respect that some people don't want to go there, but I do feel it's kind of like we've been in a campfire in the forest somewhere, and there's a handful of people that are camping. We're all sitting around the fire, and half the people say there's something moving in the bush there, and the others are all saying, no, you're a conspiracy. You're just a nervous camper. You're just joining dots that aren't there to be joined. And actually, it's like the wolf broke cover, literally. That's the key point I would take out. And you said, it was almost the first thing you said. There is no doubt in my mind that there is serious behind the scenes orchestrating of a great global reset. We took the Great Reset as our brand about 6-7 years ago, and they've taken it off us. I don't even want to touch the phrase anymore. The World Economic Forum, all sorts of people are literally prophesizing things that they're probably actively involved in bringing about. If you take all the history behind them and all the people involved. But as you say, it's not good news. It means there is a new war, and it's a war against the citizen by the overarching governments and the people behind them. It's now a case of at least we know it's going on. If you're reasonably awake and they've broken cover, there's a wolf in the bush, and you've seen it. It's now a question of how do you sleep tonight? What kind of preparation do you do, and how do you prepare? And I suppose one of the core thrusts of where we hope to add value for people, and you do very much the same. And by the way, people should absolutely be following. We've got 573 guys here, live stream going on. You should go grab right now George Gammon, if you're not already following, channel for the amazing whiteboard illustrations that he does that breaks everything down in great detail. And he tackles topics quite boldly, where some prefer not to tread. But that point aside, building wealth in an environment where it looks like the table of the casino is being tipped and all the chips go to those that are leveraged long and have the means to be leveraged long in the various hyperinflating asset classes. And the rest of the people are breadline or working businesses and having their small businesses crushed, whilst big megacorp online businesses are absolutely flourishing almost. So we have this polarization. My 2017 YouTube said there are events coming, and all I know is there's going to be a major polarizing event. You will either be part of the plebeian class, or you will make the cut in having sufficient income to buy off your way of draconian and very authoritarian future government. And that's the only way to see it. And if it's not pleasant to hear, it's still a truth. We shouldn't be stopped from being able to say it. But at least now we probably have a higher degree of conviction that the wolf has broken cover, and that's exactly what it is. So if we take that piece of information, there's a question coming for you out of all of that preamble, doesn't that make all asset classes which are not debt and fiat itself the big long? In other words, in spite of stinky stocks being as hypervaluated, they probably will go higher. Bitcoin and gold and silver are like almost must-haves for the long. Doesn't that mean it's the leveraged long trade season for most tangible assets that are finite of any form? We're seeing copper, uranium is stirring up. We've seen coffee, so we're going to have soft agri bulls. You can choose your market in tangibles. Yeah. Is this not the season of the great long? What's your take?
I think it is, but you got to be careful. And you have to study the great investors. And I would suggest that everyone, before they figure out how much gold, silver, Bitcoin commodities they want to have in their portfolio, they read the Market Wizards books by Jack Schwager.
Yes.
Because then you're going to understand that the pros and the guys and the gals who win at this game long term, and the people who have an edge, aren't necessarily the people, are not the people who get hyper focused and allocate 99% of their mental bandwidth to what to buy or sell. That's not how you play the game. The way you play the game is you have to allocate 90% of your mental bandwidth to portfolio construction. And you have to allocate another 5% to understanding your own personality and your own emotions.
Yeah.
And then maybe 5% to picking, okay, do I like Bitcoin? Do I like gold? Do I like uranium? Do I like all these other things? It's most people, I think, would be far better off if they allocated an opposite amount of time and energy to actually what they're doing. So now, having said, and the reason I say that is because so many people, and the gold bugs have been just as guilty of this in the past, and the silver bugs, where they say, well, I think that there's a 100% 100% chance that gold, Bitcoin, silver, fill in the blank, is going to the moon. And therefore, I'm going to take every credit card I have and max it out and buy, fill in the blank, Bitcoin or gold. And I see so many people doing that in the comments of my videos and on Twitter. And it's, for me, I always want to go out there and take the other side of the argument, whether it's in gold or Bitcoin, just so people realize that hey, there's not 100% certainty of anything going up. That we are imperfect creatures living in an imperfect world, and if you think there's more than, let's say, a 60%, maybe 70% chance of something going to the moon, then you're not understanding all the variables. You don't know what you don't know. Trust me 100%. On that one.
Yeah.
And it's ironically, it's usually the very unsophisticated investors or traders, because I don't think they've been burned in the past to have that knowledge scar that the guys like a Jim Rogers or a Stan Druckenmiller would say, no, that this is, I don't care how bullish I am on XYZ, it's not going to be more than, let's say, 10% of my portfolio. So that's kind of the warning label that I would give prior to my answer. Now, that said, I do agree that everyone, it would behoove them to own gold, own silver, own Bitcoin. I would own them for different reasons, though. So for me, I always say I like to set up my portfolio in this 10-80-10. So 10% allocated to physical gold. That's just insurance. And then you've got that other 10% that would be allocated towards speculations. And I define that by things that would just seem to have a lot of asymmetry. So going back to March, I bought a lot of uranium because I saw it as a really good speculation. Bitcoin, same thing. Great asymmetry, great speculation. The gold miners, the silver, those are things that don't necessarily pay me to own them, but I think the upside versus downside is very attractive. Then with the bulk of the portfolio, 80%, I allocate that to investments, and I define that as things that actually pay me to own them. So right now, or back in March and April when I was buying the most, that would be dividend producing, dividend paying producers for these commodities, such as coal, such as oil, such as copper and things like that. If you could get one with gold, that would be fantastic. But so these things are paying you to own them. Rental properties would be a good example. Maybe there's some bonds. I would not touch the bond market in the developed world with a 10-foot pole, but maybe there are bonds. Last time I spoke with Jim Rogers, he was thinking about buying ruble denominated bonds. And so, that is an example of something that would pay you to own it. So you can pay to wait until the investment thesis pays off. But even if it doesn't, you're still ahead on the bet, right? So that's one reason why I went into real estate so heavily in 2012 was I knew that I didn't know what I didn't know, going back to that. But if I could buy XYZ property, and let's say I have $75,000 cash in, so I buy that, and these were actually, believe it or not, real numbers back then in the Midwest, in good neighborhoods. You could buy a house from a bank, they're just giving them away, call it $50,000, $55,000. You put 25 or 30 into it, so let's say you're in it, $75,000 out of pocket, and the thing would rent out all day long for $1,000 a month. So that math works all day. So my point is, that's an example of an investment that doesn't need to do anything in order to work. All it has to do is do exactly what it's doing on day one. Where you contrast that to like uranium, when I bought it back in March, where it's got to go up in price. There's got to be more buyers than sellers in order for that to pan out, right? A rental property isn't that way, or potentially a dividend paying stock. in the commodity space. It's not that way. And I work a lot with Lynn Alden and Chris McIntosh, and they're, the pros. I'm an amateur, but we talk about stocks overseas that are paying fantastic dividends, that are going to benefit from a stagflationary environment. And you could just sit back, hold them, and you get paid to wait. So that, again, that goes back to that portfolio construction. And I like to be far more cognizant of that and allocate more mental bandwidth to that than just trying to figure out what's going up or down.
Yeah, I like a lot of that. There's also, in terms of what we're discussing, is given the extent that these things may move, there's also an inherent volatility that goes hand in hand with that makes for a very bumpy ride. And especially if anybody has not earned the right to leverage and decides to bring it to bear, you can actually lose going long in a very strong long market, just because some of the harshest, most vicious dips can actually occur in an upward climbing market as well.
Yeah, it gets super choppy. In fact, on that note, I was listening to my good buddy Luke Groman the other day, and he was talking about gold during the hyperinflation of Weimar Germany and denominated in their local currency.
Yeah.
And you would think that if you would have bought gold, that you would have just made an absolute fortune. But he said, if you look at the yearly charts, that's true. But he says the mistake they make is they don't look at the monthly and weekly charts.
Yeah.
He says, if you look at the monthly and weeklies, you see that the price of gold was so volatile.
Yeah.
Up, down, up, down, up, down, all over the place. That yes, over the span of a year, the price went up and up and up because of the hyperinflation.
Yeah.
But especially during those first few years of hyperinflation, where it's losing, let's say, 50% per month or something like that, as far as the currency. He said, if you would have purchased gold on leverage back then, you would have been wiped out like 2 or 3 times per year during hyperinflation, where the currency is just absolutely crashing just because of the volatility. And that's a great point, and that's something that most people don't realize. I was listening to the original Market Wizards books actually this morning, and just reminding myself, I like to do that all the time, just remind myself of the real fundamentals and how the pros operate, and remind myself that it's not just about thinking you're right or wrong, but it's actually defining what your mathematic edge is. What is your edge? And if you can't define exactly what your edge is relative to everyone else, then you don't have an edge.
Yeah.
And if you keep doing what you're doing the way you're doing it, over the long run, you're going to lose money because you're betting against the house, right? But anyway, my point is there was one of these professionals that Jack Schwager was talking to, and the guy was talking about one of these trades that he did early in his career, where he went long soybeans on using a bunch of leverage, and he kept like 4 or 5 days in a row. The market opened like limit down to where he could not get out of the trade, and he was losing like 10% of his net worth daily. And he was talking to, and mind you, this is a guy that had been doing this. He was a pro at the time. Now he was a younger guy, younger than he was at the time of the interview. But let's say he'd been doing it for 4 or 5 years up to this point, and he walked through the emotional roller coaster of losing that 10% per day. And I mean, he was almost suicidal. Like he was crying. He was thinking that all these people out on the street were intentionally trying to or taking getting satisfaction out of him going broke and becoming closer and closer to having to get a real job every single day. He was having these nightmares. And I mean, so think about that. This is a pro. This, they've been doing this for 5 years. People just don't understand the emotional impact of not only when the bet goes against you, but also when it goes up. So what do you do? What do you do if gold goes to 10,000?
Yeah, it's emotional.
Like most people are just like, "Ooh, I'd be celebrating." No, you wouldn't. You'd be even under more stress
Yeah.
because it's so much of your portfolio and it's so meaningful, it's so significant that now you're sweating bullets. You probably can't even sleep because
Yeah.
you don't know whether you should sell, whether you should buy.
Yeah.
You've got this internal debate and dialogue going on in your head just constantly. You can't eat, you can't sleep. That's what most people don't realize.
Yeah, it's very intense, and you pay for your profits in emotional stress. And as you say, if gold does go to 10K, I mean, it just has to dip $500, and you think, damn, that's it. It's crashing. And then you get hyper emotive, and you jump out, and then it goes up 1,250, and you go, damn, I knew it would make a new high, chase back in. And I've got to make up for that, which I've just lost. So you jump in leveraged, and then it's a marginally higher high, and then it has a real 25% crash. It's super emotional. In the absence of method, you're going to get killed. And not respecting leverage. I think Peter Brunt has said it a few times. I don't agree with everything technically he says, but he's right. Anyone who's been around for long enough, the money management is the game. Then you can talk about approaches and technical entries and stops and targets. And I warn the guys with Bitcoin, with as much as we expect these ridiculous potential numbers with this institutional money. The first part, I think, will be relative dips, relatively small. Once we through 25,700, I think we could have some beautiful 25% corrections potentially. When you're at 60,000, boom, you can drop 15K and be at 45 again. And then you can go racing to 90. And that's, as you've said, the micro detail of those gold charts in Weimar. I mean, there was a limited availability of good information during such a traumatic period. And in some senses, history prepares you for the future. I'm starting to think there's going to be such turmoil. It's quite clear they're going to be doing a reset. There's going to be dramas. You've got Klaus talking about electrical grids going down. That's why you have gold and silver, not just Bitcoin. You just spoke about portfolio theory. Guys, we love Raoul, but he's talking irresponsibly long. And I've mentioned people, Raoul's position isn't necessarily yours. He worked at Goldman Sachs. He's got a big investment portfolio, and he probably still has other stuff like the home he lives in and many other things. So guys have got to have a stable, not a single racehorse, potentially, and watch the leverage because the volatility and going back to your Weimar Republic example, I imagine people didn't know what was going on. Government decree, there's such panic in government and the communication. They're busy deciding, what do we tell the public? Often they deem it's not in the best interests to fully disclose. So they mislead, they jawbone, and this then leads to people reacting in the day. Maybe this is the end of this. It can't get any worse, and then boom, we're printing another 10 trillion. Shoot, then it's collapsed. No, we won't be doing it. So it must be very, very confusing. And I think we're going to have that level of confusing. I mean, we've just had an election where you can talk to two different colors and you get two completely different stories about the same event. One are convinced that there was fraud and all sorts of it, and the others probably think it was negligible or not at all, and that you're just trying to disenfranchise them. And it just shows how you can get two totally different perspectives. And I'm sure you will have your opinion, and I have mine too. But we're going to have a lot of that, I think, with the unfurling. It's going to be chaos. It's almost like it needs to be chaos. It falls into that problem, reaction, solution. For something to be truly a problem, you need chaos. You need fear. It's all emotions that are related to confusion, lack of good quality, reliable information. And that's what makes markets gyrate.
Well, that's right. But you see, what they've done and tried to do is take out that volatility in the market. And I think Chris Cole just nails it when he says you cannot destroy volatility.
No.
You can only shift it.
Suspend it for a while.
You can only go from the markets to society.
Yeah.
And I think that going back to the first part of our conversation when we were talking about the economy being built on asset prices, debt, and confidence, in asset bubbles being the main component there. The more the central planners, try to prop up those markets and eliminate volatility, the more volatility you're going to have in society at large. And I think looking into 2021 and 2022, that's what we really need to prepare for. Because, I was reading a statistic the other day, and I almost fell out of my chair. The statistic was the number or the percentage of adults age 18 to 29 who still live at home with their parents. This was in the United States. And prior to me seeing the actual statistic, if you would have asked me, I would have said, well, it's got to be high. So I guess maybe 5% or maybe 10%. Because I just remember back when I was 17, 18. And this wasn't just with me. No. This was everyone in my entire high school. You're gone. Yeah. Like you're gone. We don't care how bad the economy is. We don't care if you're going to be homeless. We don't care if you can afford rent. We don't care if you can afford food. You're gone. And it's time for you to be an adult. And that was just the way the cookie crumbled back then. Yeah. And so anyway, that's why I'm thinking 10%. The real percentage is 52%. Wow. 52% of adults 18 to 29 still live at home with their parents. So you think about, okay, that group of people most likely doesn't own assets, and it's all the baby boomers and the people who have just inadvertently listened to Dave Ramsey, therefore they have a 401k. They're the ones that have benefited from all of the central bank and government shenanigans. And it's only going to get worse. An anecdotal story that I'll tell you, just being right here in Phoenix, is the building I'm in is right in the same area where I used to live back in 2000, call it 7 to 2010. Basically, they're sister buildings. And so it's in an area called the Biltmore in Phoenix, 24th Street and Camelback. When I lived here back 2007 to 2010, there was zero homeless people. The Biltmore is one of the nicest areas in all of Phoenix. In order to find someone homeless, you would have had to go down the street, probably maybe call it 5, 6 main streets before you started to get in some rough areas there where you might see a homeless person. Yeah. Now, there are homeless people everywhere. Everywhere, walking down the sidewalks with the shopping carts on the corners, begging for food outside of Whole Foods, Trader Joe's. It's always these kind of yuppie rich person places where you see a lot of the homeless, ironically. But my point is going down to Old Town Scottsdale.
I know Scottsdale.
Let's go back to 2008. I used to have. I'm a big car guy, so back in 2008, I had what they call a Lamborghini Gallardo. Okay. Yeah. So me too. Back then, I would take that car down to Scottsdale, and people would be like, "Wow, holy cow! Wow, that's a neat car." People would take pictures of it and stuff like that. Now, if you go down to Scottsdale in a McLaren or a Lamborghini or Ferrari, something like that,